What's up, everyone? My name's Robbie. This is Robbie Amnila, and today we're talking about the best small cap growth ETF. So if you're new here, welcome. My name's Robbie. I make videos about ETFs, about stocks, about investing in the stock market, what's going on in the bear market right now. And basically what I do is I do these video series, and one of these right now that we're doing is the best small cap series. I've done the best large cap, I've done the best mid cap, I've done the best sector series. So these are all about ETFs and the best ETFs in each of these sectors. Go back and watch some of my old ones if you want to see anything involving large cap, small cap, large cap, mid cap, or what's going on in different sector ETFs. To show you how this kind of works and why some people like to do this, there are different time periods where specific styles of investing outperform the others. So for example, if you were investing in large caps, which is this black line here, you would have done better than if you had invested in the red line, which is the small caps. So these are the small caps, these are the large caps. So over this 10-year period going back to 2012, you would have had about a 255% return if you had invested in large cap stocks. If you had instead, during that time period, invested in small cap stocks, you'd have only had 149% return. So bigger return, right? You have a much bigger return if you had invested inside large cap stocks. Now, if we change this, so here we're going from 2008 until around 2018, and we can see here, if you invested in small caps, you were actually rewarded over investing in large caps. So 170% return for small caps versus large caps, only 134% return. So a lower return during that time period if you had invested in large caps over small caps. So this is the thing. Some people have opinions and ideas about why you'd invest in small caps or large caps or mid caps. I'm not here to tell you which one's best today. I'm just really here to tell you which ETF I think is best for this specific style. Okay, so here we go. These are the different ETFs we're going to compare today. We have 5 of them. We have VBK, which is the Vanguard Small-Cap Growth Index Fund ETF shares. We have SLYG, the SPDR S&P 600 Small-Cap Growth ETF. We have IWO, which is an iShares ETF. This is the Russell 2000 Growth. We have the SCHA, which is a Charles Schwab ETF. This is the Schwab US Small-Cap ETF. And then finally, we have something called CAF, which is it's funny because I'll show you in a second, but it's the Pacer US Small Cap Cash Cows 100 ETF. So cash cows, calf, funny play on words there, right? So is that a play on words, or I forget what they call that? I'm not good at English. So let's go on and see what we have for the expense ratio. First off, we have with VBK a 0.7% expense ratio. So this is going to be one of the cheaper of the ETFs we have today. Then we have SLYG. We have the 0.15% expense ratio. IWO with a 0.24% expense ratio. SCHA with the lowest today at a 0.04% expense ratio. And then we have CAF, which is that Cash Cows ETF, 0.59% expense ratio. Definitely the highest expense ratio out of all of these today. And so we start off with the question, is CAF worth spending so much more than, let's say, a SCHA or a VBK, right? If the expense ratio is so much more money, if it's going to cost you, not a lot of money, because 0.59% is not huge, but definitely over time, it's going to cost you more money to invest in this type of ETF. All right, so let's go over the yield of these ETFs. So if you're not sure what that is, think of like the dividends, right? Dividends, the yield, right? What these ETFs are paying you to hold the money in the ETFs right now. So the distribution yield is 0.39% for VBK, much higher for SLYK, 1.10, IWO only 0.51, SCHA much higher, 1.56. CAF has a very high distribution yield at 3.49, so definitely the highest out of all of these. All right, let's go over everyone's favorite part, which is the returns of these different ETFs. We're comparing them all together to each other. And this is including reinvesting the dividends of the ETF. So what we have here is we're starting off just looking back in June of 2018, and we're going to go forward here, and we're going to see what happens. So first off, SPY is the S&P 500. So we like to see if these ETFs, how they've done against the S&P 500. I know the S&P 500, of course, it's a large cap ETF, so that's, it's not apples to apples, but I do measure what I try to do is beat the S&P 500 annually. So that's how I look at this. So I want to see how these have done. Of course, they're small cap ETFs, so they shouldn't have beat the S&P 500, but going forward, you want to, if you're investing in these things, hopefully you're investing because you think small caps are going to maybe outperform. So let's go forward here. So first off, CAF is the best performing in this time period. Then SLYG, VBK, SCHA, IWO. Now, when you kind of move this forward, you kind of watch and you see what happens. They move around. CAF is pretty much consistently staying on the top here. VBK, SLYG, kind of hitting those next two spots. And, we just kind of watch and see what happens going forward. And, I would say SLYG is probably the number 2 ETF on this in terms of return. And then there's CAF, right? And so CAF has times where it's definitely really outperforming, 99% return since, what's the time here? Since, May of 2020 versus SLYG, which is 57% return. So much higher return over that time period. We keep going, we see what happens. And now suddenly CAF is down closer to SLYG. When we look more closely, so this is about just let's say about a return over maybe 13 months, 14 months. So it gets closer, and so that's what we do. We take a look at the different returns. Right now, I'm seeing the way we look at the returns here. CAF and SLYG are two of the top performing ETFs based on the returns. Okay, so last thing we're going to do before I tell you which ETF I like the most is we do want to look at the portfolio. And I do want to go over, first off, the portfolio of these different ETFs, and then I want to get to my favorite ETF. So the first thing is I just want to show you that all of these ETFs have quite a few stocks in them. SCHA has 1,813 stocks, so big portfolio. IWO 1,129, SLYG 337, 719 for VBK, and then you have a more concentrated portfolio with CAF. So large portfolios, except for CAF being mid-sized portfolio with 101 stocks. So these are the different companies inside of the top 10 holdings. I'm going to go through these, just pause it if you want to see this. And so that's about it. I do want to show you real quick that the weightings of the different ETFs. So VBK does have a little bit of mid-cap, but it is predominantly over 50% is in small and micro-cap companies. And then these other ones are also mostly small-cap and micro-cap ETFs. You do have 16% in SCHA that's considered mid-cap, but again, predominantly it's small-cap ETFs. So, okay, I'm going to go ahead and I'm going to pick my winner for this category. So this is a bit of a tough one for me. So sometimes you have to decide if you really want to go with an ETF that is potentially going to outperform, but spend a little bit more money for that ETF, or if you want to go for something that you think may slightly underperform the better one, but not have the expense ratio. So what I kind of want to do here is a bit of a split decision between SLYG and CAF. I do like those two ETFs together. I think CAF, a lot of people don't want to pay 0.59% as an expense ratio for an ETF. So if that's you, then CAF is not going to be for you. So then you're going to want to go with SLYG. So SLYG was coming in right under CAF in returns most of the time, right? So I'm going to just say that it's a split decision. I do want to go over technicals of one of these, so let's go over SLYG. All right, so this is SLYG ETF. Just going to take a look at the chart real quick, see what's going on here. So first off, we're going back here. Where are we going to? We're going to May 20th of 2020, not May 20th, to May of 2020. So obviously, most stocks, they're up nicely. This is an ETF, not stocks, but basket of stocks. So this thing, I do have a little bit of let's say a support that was here for a while. This stock, or this ETF rather, broke down through support. Now, when did this happen? We're zoomed in, and we can see that this happened back in January of this year. So January 2022, this support is essentially, it's broken, and it starts trading down into this downtrend channel. As you can see, the parallel channel line here on the bottom. It's had multiple touches, and on the top you've also had multiple touches. And so where we are today, well, we're at the top of the channel essentially. So we're looking like we're going to have a little bit of a resistance in this top channel line. It's starting to, let's say, decline and let's say potentially go back down. I don't necessarily think it's going to go down to the bottom of this parallel channel, but all I'm saying is that this thing is heading down off the channel line. It could potentially come up, of course, and if it does break through this, it's a very volume-driven breakthrough here. This thing could go up quite a bit. Maybe it could go up to this old now resistance line, previous support, and that would be a great game. Now, I don't think this is going to necessarily happen, but if it did, let's just see what would happen here if it did happen. So we're looking at about a 17% rate of return if we do get back up into this now resistant line. That's about it. That's all I'm going to do today for this. I'm not going to go too far into details. Most of you probably aren't trying to enter positions into ETFs like this. You're probably dollar cost averaging for buying it. But anyway, that's it. Hope you enjoyed it. Hit that like button, subscribe to see future videos like this. I got another video coming up on the end screen. You should probably watch it. You should click it right now. Thanks everyone so much for watching. I do want to remind you I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence.